If you're an active or passive investor, what can you do to save the middle class? Find out on today's episode of Impact and Income.
Welcome back to Impact and Income. Today we're going to talk about, the low to middle class and what type of opportunity we're presenting, because we have many different assets that we're able to provide, a lot of different value adds that we can provide, not only to what we're doing in our physical business, which is saving low-income borrowers' homes, low to middle income communities, but we're also providing on the back end. Our product, what it actually is a reperforming loan. So how do we allow low to middle income investors an opportunity to invest in this elusive asset class when, more than 97% of the Americans out there right now do not have the opportunity to invest in a certain type of asset class and make the type of money or the type of opportunity that the other 3% of the country out there, because there's something called accredited and non-accredited investors.
Right.
Our vehicle for our fund is a Regulation A+, right? Thank God for the Jobs Act, because it allowed us now to solicit funds from accredited and non-accredited and generally solicit.
Yeah, we not only deploy the investment capital we have into the lower to middle class to try to save their houses, but we also give the low to middle class that opportunity to invest back. So we're doing something different with the Regulation A+ fund. We're taking an investment fund to the masses. We're able to allow not only accredited investors, but non-accredited investors to make an investment as low as $200 into our fund and help shape, form, rescue the middle to lower income.
Yeah, when we decided, when we went to Fort Lauderdale that one day to a convention about, what kind of fund structure should you use? We were both looking at each other and going, well, I don't know, what kind of fund structure should we use? What's our mission? And it just didn't feel right to go out and raise capital from just accredited investors when we're trying to incubate and build inclusively our country from helping the low to middle income class. So we said, let's lower this minimum investment to $200, right? You can do that per month. You can do that $200 one time just to test the waters. You can do that type of stuff, and really what it's doing is allowing others an opportunity to invest in this elusive asset class, pay it forward, because let's just say, for instance, we help Bob and Joe Smith, right? And we help them save their home. And next thing they know, they're like, okay, they're on good standing. And next thing they know, they're like, well, should we invest in something? And now they have an opportunity to invest in what just actually helped them get out of a hole.
Yeah, across the board, we feel that it is a great investment, and this is something that was prior to the Regulation A+ fund. You only had the ultra wealthy really investing in the non-performing debt space. By jumping in and opening up the Jobs Act, which is great, like you said, it has allowed companies like ours, and I think we're going to be one of the only institutional capital funds out there deploying money directly into the low to middle income, but also taking money from the low to middle income and letting them invest back into their own communities, help themselves out, help others out like them.
It's funny because whenever we say what we're doing to other people and we're talking about we need inventory in these homes and these non-performing notes, they're always telling us what? Nobody is buying the stuff that you guys want to buy. What does that mean? It doesn't mean nobody's investing in this class. What they're doing is nobody's investing in helping the people, because at the end of the day, you're buying a mortgage loan. There's a person, a family attached to this. That means nobody is helping these things. They're running that marathon, like you had that great thing of, you're running 22 miles with an institution. These borrowers go through an entire process of modifying their loan. They said they're going to be helped and promised all these good things, and they get to the end and they say, well, you got to start over again.
Yeah, you've ran the first 22 miles in the wrong shoes, because we sold your race to a different company and they want you to run it in their shoes.
Yeah.
And that's essentially what happens is the borrowers will go through the process, and it is so tedious, it is so ridiculously hard, and they'll get to the end and that bank will sell their loan to another bank, and the next bank says, well, we can't accept that paperwork, we need it on our letterhead. So they have to start the process all over again. It's no wonder people are throwing up their hands and like, you know what, somebody help.
Just to get everybody on the same level as us, What we're doing is we're buying non-performing mortgage notes, low balance stuff. We're turning them into a sustainable living situation for these people by modifying their loans, with which really only smaller type institutions, smaller type investors can do, because we're still regulated just like the big guys, but it's a very, distressed debt investing is very entrepreneurial. These people that are handling these low to middle income borrowers are not entrepreneurial. So their hands are tied, they cannot come up with creative solutions. Thus, these people are really the victims of a bad situation. And so our product is a re-performing loan, a sustainable situation. And they always say, you know, you gotta bake that cake good. So the way that we approach it is we really make it to where it's an affordable situation for this borrower. And we've also said, well, you know what? We have to sell these, right? We have to one of our missions is to redistribute this wealth that lies in this type of asset class to the everyday investor. Right. How do you do that? Well, we've developed an awesome trading platform called PaperStack, paperstack.com with a C, not a CK. And what that's allowing us to do is take our product now and market it to the masses. Because what we found is that when somebody is managing 10 loans, the type of borrower experience that gives somebody that is going through a hardship is 10 times better, 50 times better than what that person would be dealing with when they were just a number. So if we can get enough of these investors interested in this asset class, right? They can go ahead and buy a loan in their self-directed IRA. They can go ahead and buy a pool of mortgage loans and get that debt service, that money coming in off of these. And like we always say, it's like real estate, except you're not, when you're dealing with a rental on this type of investment, you're dealing with having to worry about fixing problems.
Fixing toilets. Yep.
Here, when you're dealing with a re-performing loan, what are you doing? You're just collecting the money, and that borrower's responsibility is to maintain that home.
So if you're an investor and you're looking at how can I help save the middle class, how can I help close that wealth gap, you can go and you can buy a loan right now on paperstack.com. Or if you're more of a passive investor and you want to go over to mwmfund.com, you can learn about what we're doing, how we're saving the middle class, and you can jump on board and make an impact and an income.